Welcome back. This is Niaga AWANI. My name is Ibrahim Sani. Bank Negara Malaysia has raised the OPR by 25 bips to 2.25% yesterday. The decision was widely expected by 17 out of 19 economists surveyed by Bloomberg and, of course, including CGS-CIMB. The growth of this is not said to be a shock, and of course the bank said that the growth, the reason why the raise was done was because of growth and not inflation, and of course the idea right now is that the economy needed to move away from what is called so-called crisis mode. Some banks do expect another 25 bips rate hike in September, bringing the OPR to 2.50% by end of 2022, and for 2023 a lot of economists are arguing to expect another 50 bips hike, raising the OPR back to 3.0%. Based on this, last night I spoke with Anand Pathmakanthan, the Regional Head of Equity Research at Maybank Investment Banking Group. We didn't talk so much about the OPR per se, but more of how the equities are going to move ahead, moving into the second half of this year. Not just in Malaysia, but all the other ASEAN markets as well. The full interview will be found on Notepad, but for now, I'll just give you a snippet of my conversation with Anand. This is Anand Pathmakanthan, Regional Head of Equity Research, Maybank Investment Banking Group.
Yeah, good morning, Ibrahim. When it comes to Bank Negara's stance on interest rates, we've actually changed our view as the months have gone by. When we started the year, we were looking at a 25 basis points hike only for the full year. Now we're looking at 3 hikes this year. We have already had one in May. We think there'll be 2 more hikes by the end of the year. So that will take the OPR up to 2.5%. I guess when you look at what's happening globally with inflation and interest rates in developed countries, they are probably 6 to 8 months ahead of us in terms of dealing with these issues. So the inflationary issues and interest rate issues are now starting to impact the ASEAN region. So you've seen inflation numbers going up everywhere across the board, on energy prices, on food prices going up. And that's pushing central banks across ASEAN to become more aggressive interest rate increases. And Malaysia is no different. So I think we will see interest rate increases continue into 2023 due to this lag effect impact on ASEAN. And that will have a bit of a negative impact, obviously, on GDP growth numbers as well. Yeah, I think the environment we're entering into in the second half of this year is going to be very challenging across the board. We've already seen in the first quarter results for the corporate sector that margin pressures are building across multiple sectors. It's not just a single sector. And this is stemming from increases in costs, basically labor costs, as well as raw material inputs as well. At the same time, we've just discussed interest rates going up, and that's going to slow down demand. So as it's mentioned in the report, we see the squeeze for corporate earnings in the second half from higher costs, at the same time, weakening demand. Now, all sectors will be impacted to one degree or the other. The sectors we've pointed out as being relatively protected or resilient in the face of these pressures. One is financials. I think financials have come through the pandemic in very good shape. There are lots of capital, lots of liquidity. They've put aside a lot of provisioning for potential credit costs, which have been very slow to materialize to their benefit. At the same time, when you talk about beneficiaries from rising interest rates, financials, or banks in particular, are one of the biggest beneficiaries. That's because the amount they charge on loans goes up faster than their deposit costs when interest rates are increasing. Yeah, we've seen multiple years of net interest margin or NIM coming down for Malaysian banks, and that's really been due in large part to the low interest rate environment we've had in Malaysia for the longest time. And that's a global phenomenon. Banks everywhere have seen margin squeezes because lending rates have come down in line with interest rates. Now we are seeing the inflection globally. All banks are going to see margin expansion because their loan books will reprice faster than their deposits. And that will basically lift earnings as long as credit costs remain under control in a weaker growth environment.